Greetings, folks. This is DC Investing. I've reached financial independence, and I'm talking about topics to help others on their path to financial independence. And today I want to talk about a topic that I've mentioned before, but I have two favorite ETFs. One is the ticker MLPA, and the other one is the ticker AMLP. I just think these are great ETFs for folks that are kind of income minded individuals. And so the reason why these two, well, first of all, now may be a good time to take a look at these two ETFs because the prices for the underlying assets have come down so much or somewhat during this year. So you're getting a cheaper price for these ETFs. And then that has the effect of causing the dividend yield to go up. So prices come down since the beginning of the year, dividend yield has gone up, and these yields are just wonderful. So as of today, when I looked, MLPA has a dividend yield of 7.5%, and AMLP is around 8%. Now you might say, well, that sounds really risky. Why is the yield so high, particularly when you can only get like 4.75% in a money market account? Well, the reason why the dividends are so high is because the underlying companies that these two ETFs own pay very high dividends. These two ETFs own pipelines, oil pipelines, energy pipelines, and the underlying structures, they are set up as master limited partnerships within these ETFs, and those partnerships just throw off income. That's what kind of they're set up to do, is to pay income to their owners. And the owners are not only holders of the shares, but also, well, I mean, everybody's holders. They're not shares, they're units, regular investors, but they also get owned by large oil companies. And so they're paying dividends to their unit holders, whether they are you or whether that's a large oil company. So they're just kind of structured. They throw off income, and they make that income because they charge shipping rates basically for moving energy around in their pipeline systems. And so most of them have long-term contracts that they are under with their upstream energy holders. And the upstream energy holders have committed, or upstream energy companies I meant, are committed to pushing a certain volume of energy through their pipelines, and they've signed up and said, we're going to commit to pay you this amount, whether or not we really use that volume or not, we're still going to pay you this. So they have contracts with the oil majors to move the energy around, and then they just pass on the funds that they make onto their shareholders. So getting a yield of 7.5 or 8% is just really great, and it may make early retirement a possibility for you, because we need funds to live on. So let's say you've saved $1 million. Well, 7.5% is $75,000 in a year, and an 8% yield is $80,000. There's a lot of folks that can live off of that amount. So by investing in one of these ETFs, you may find that, hey, if I own these things, I can retire, and that's enough money for me. So that's something that is interesting to consider. Now, I have owned these ETFs somewhat. I've tinkered with them, but I actually ended up purchasing the stocks that are underneath it, because I think that's a little bit better value. But you get a K1 statement for all those master limited partnerships. A lot of people won't be interested in that, but you do not get a K1 statement for owning either MLPA or AMLP. That's one of the nice things about the ETF, is they handle all those tax issues for you, so you don't have to deal with that. The dividends that come, just be aware that they do not get paid to you as qualified dividends. They come to you as ordinary dividends. So that's something to be aware of, because that can impact your tax statements a little bit, because qualified dividends, you pay a 0% tax on up to about $94,000 if you're married. So you earn that much in a qualified dividend and not have to pay taxes on it. But these two, they pay ordinary dividends, so you're going to be paying taxes at your ordinary income rate. So just know that, be aware of it. The ETFs also charge a bit of a fee. It's about 0.5% to manage those fees. So it's, if you don't want to deal with the K1 statements, then that's the route that I would suggest going, is just buy the ETFs. But personally, I like the pipelines, and so I've purchased a lot of the master limited partnerships underneath them. I used to own the ETFs quite a bit, but eventually I just sold out of those ETFs because I wanted to not have to pay that 0.5% fee every year. I don't mind doing the K1 statements, but then I get to still have high dividends on these things. So those two are right now, the pipelines have all somewhat come down. The master limited partnerships, anyhow, the prices as they come down make the dividend yields go up. And now may be a really nice time to pick up some great yields. So again, MLPA is 7.5% and AMLP is 8%. It's just based on the things that they own within there. You buy those ETFs, and then every quarter you get a quarter of that dividend. It's a really great dividend. It's unlike many other things that are out there. It's not like a BDC where the interest rate change may impact the rate that you get. It's not so much like a REIT where the retail location might go out of business, or they might be in some kind of sketchy commercial real estate or something. These are just moving energy around the company or around the country. So that's just it's important to know what you're owning underneath those. I guess I'll say, if interest rates fall, then it makes these companies more attractive because all of their debt can be refinanced at a lower rate. So that's a positive for them. Where somebody like, some other things might go in the inverse of it. So just overall, take a look at these ETFs that can be kind of an interesting addition to your portfolio on your path to financial independence. They can help you retire early because they're throwing off a really nice yield that you can then spend every year. So check it out. Like, subscribe. Thanks so much for being part of the channel. We'll see you. Bye.